Do you believe we can have a soft landing?
No, it's impossible. People have to realize the enormity of this bubble. There is not a comparable bubble in real estate. This is going to be worse than the crash before, and it's going to be way worse than the real estate crash in the Great Depression. This is going to show why the Federal Reserve and central banks shouldn't be manipulating the economy. These people are dictating economies, playing with the money supply, and it's dangerous because of these giant lags. This is a first in the world. Economists don't understand this because they think it's all politics. I don't study. You know how much time I spend studying politics? None. I don't care who gets elected president. They don't drive this ship. And all I can tell you, since there's no precedent for a bubble this big and this global, it's not going to end well.
Economist and best-selling author Harry Dent says home prices will crash by at least 50%, and we'll never see them as high as they have been over the last several of years, at least in our lifetime. Now, if this is true, in order for this to happen, we would have to have a massive financial disaster headed our way. But before you turn your nose to Harry's predictions, listen to what Harry is saying and then ask yourself, despite his timing being off so far, as Harry, or nobody for that matter, can control the last-ditched attempts from the government to kick this can down the road, you have to ask, is there truth to what Harry is saying? And I will say this, if we don't have a massive recession, this would be the first time in history that no economic downturn comes after an economic boom. Now, many economists believe, including Harry Dent, that we'll see the largest economic bust in history, way bigger than the 2008 global financial crisis, and maybe bigger than the Great Depression. And some of these economists are saying it's already begun. I hope you enjoy the show. Harry, welcome back to the Sachs Realty podcast. It's so great to see you.
Yeah. Down in Puerto Rico, where the weather's almost damn near perfect. It's unbelievable.
Yeah.
The good thing about having mountains, unlike Florida, is the mountains get all the rain, so we get all the sun and they get all the rain, so we have plenty of water and plenty of sunshine both.
Did you guys see anything from that last hurricane?
No, that went good. I mean, we got one bad day, like a bad rain day and wind, but it went well below us.
Yeah.
We are in the strike zone, so 1 out of 2 serious hurricanes we are going to get, so we got lucky on that one.
Yeah. Well, today we're going to talk about the U.S. economy, especially the housing market. And you've said recently that the stock market will crash, the housing market will crash, and the debt bubble will explode. And it's kind of all happening now as the government's ability to prop up this economy, I think, has been exhausted. So,
we're at the end of the greatest debt bubble, and we've never seen 2 bubbles in a row. That's another unique thing: 2 real estate bubbles and 2 stock bubbles, and this time the stock and real estate bubbles are kind of occurring together. So that's a trip.
Well, we've never seen a housing bubble like this. I don't believe. I mean, I've been serving the housing market for about 35 years, and since 2020, home prices have absolutely exploded. In your opinion, has this housing market crash finally started?
Well, I think it's just cresting now. I think it's about to start. I tell people, in real estate, look at the stock market, because the stock market tends to be the more leading indicator for the economy, and then housing tends to follow. And the difference, if you look back at the last downturn where stocks peaked in late 2007, real estate started peaking before, but real estate didn't bottom until mid 2012 when stocks bottomed in early 2009. So when you see the stock market start to fall, that's when you start to say, okay, I don't have long to sell my house if I'm looking at selling, because this real estate bubble is the second in a row, never happened before. By the way, even the roaring 20s, there really wasn't much of a real estate bubble because loans were hard to get back then. In the roaring 20s, a mortgage loan was 50% down in 5-year terms. You have to pay off the whole loan in 5 years. So The stocks got speculated in and got bid up. Real estate just had a normal kind of boom and bust. It only went down 26% in the Great Depression. Stocks went down 89% in the Great Depression. So that's what's different this time. Real estate really is even more so the heart of this bubble. And financing, since the kind of the 80s forward, and particularly the mid 90s forward, financing has been so easy, and interest rates keep getting pushed down by the Fed and falling inflation. And that was all because of the baby boom. So this really has been the most global and the biggest real estate bubble in all of history. In fact, I'm telling people, I don't think we'll ever see one this big again, and we haven't seen one this big previous, even going back to the 1800s or something. So this is a big deal. And normally people say, hey, it's my house. I'm going to be in it forever. Okay, well, yeah. If you're thinking of trading up, don't do it now. Stay in your smaller home and wait. If you're thinking of selling and maybe retiring and downsizing a few years from now because you're an aging baby boomer, well, sell your big house now and wait a few years to see if this crash sets in, which I think is very, very, very likely to buy. So real estate's the biggest purchase we make. And again, never before a bubble like this because of such easy financing for housing mortgages. And I'm telling you, the people who I feel most sorry for in the world are the Chinese. Chinese have incomes more like 12 to 15,000 in US dollar equivalents. And the typical Chinese household is buying one little house and then buying one or two more and leaving it empty, not even renting it out because they think real estate is the road to wealth. So as bad as our bubble may be the biggest we've ever had in the US and bigger than the one that peaked in 2006 and crashed 34% on average in the US, this bubble will be bigger here, but the Chinese are going to see the real estate bubble burst of all times. And that is going to take that economy down in a way nobody expects. And China will never fully come back because they're the only emerging country that has seen a peak in demographics. That, in other words, their population is aging like the developed countries, even though they're emerging country with lower incomes and they have some urbanization left. But I'm telling you, the real estate bust in China is going to go down in history and going to make us feel good about, a home price is going down 50 to 60% here. Now, real quick, I mean, I was previously warning, hey, the last one was 34% on average. That means upscale homes were going down 50% or so. And again, nobody ever thought, I was told all growing up, real estate's the one thing that never goes down. They ain't making more of it and stuff. Well, that proved that wrong. But this bubble has gone much longer, much higher. And now I'm looking at just getting back to the mid 2012 lows, not that far ago. And that is about a 60% drop for the average house. And of course, that could mean 70, 80% or more for high-end homes and condos. And one of the funniest things I get every time I give a presentation, usually some older lady will come up to me and say, Harry, let me tell you about my house in La Jolla. It's on the cliff. It's the greatest house. It's got this and that. Certainly, Harry, my house isn't going to go down. And I'm like, Martha, I'm sorry. The bigger the bubble, the bigger the burst. The best houses are going to bubble the most in a market like this and go down the most. And they'll still be the best houses. And that's exactly what I want to buy on the other side a few years from now. The best houses, in other words, somebody may be looking at a 3,000 square foot house today to trade up into. And then we come out of this, you may be able to buy a 4,000 to 5,000 square foot house for less than the 3,000 square foot is today. And so this is going to be what I call the last great buy opportunity in real estate. We did get one in 2012 and shortly after that. And otherwise, you'd have to buy back in the early 80s in the deepest recession back then. So this is a huge threat to what is the biggest asset for most households. Most people own more real estate than they do stocks. Only the richest people have a large amount of stock. The biggest threat to your net worth, but also the greatest buy opportunity just a few years from now if you'll be patient and if you'll sell any unnecessary real estate. Let's say you have a nice home you're living in and you got a vacation home and maybe you're considering retiring in that vacation home. Okay. It'd be best if you could sell the most valuable house and the one with the most equity in it now and raise as much cash so then you can have the most to buy real estate at the buy opportunity of a lifetime years from now. So, and then the other good thing about real estate, just before, you ask more questions, is that real estate does take longer to bottom. So there's going to be a longer opportune buying opportunity here. Last time it was like 2009 to 2012, where you could have still bought them near the bottom. So I think this one you'll be able to start buying houses maybe in 2006 at great bargains, and that may extend out to 2008 or longer. So so people should really be looking at real estate, vacation, investment, main homes, everything, retirement, and say, what do I really want? And then be waiting to pounce, knowing this is going to happen, and build up all the capital you can now. And some people will come to me in my presentation and say, oh, hey, I got this house with a big mortgage on it. My second house doesn't have much. Oh, I should sell the one with the mortgage. I'm like, no, keep the one with the mortgage. The banks may have to write that down for you if it goes down enough. You may get a freebie there. Sell the one with the most. Almost everybody gets that one wrong. They think they should keep the one with the most equity and sell the one with the most debt. No, keep the one with the most debt, because the bank, you're very likely to be able to, if things get as bad as I say, a 50% or more drop in real estate, banks are going to have to renegotiate loans with people, and you may get that high mortgage house written down. So you sell the house, create a big, the house you own the most of, get a big pile of cash, and then maybe get your mortgage written down a few years from now with the government helping to subsidize banks do that. And I think they'll have to do that. And you just win across the board.
Interesting. Well, I want to unpack a couple things that you said, because I really never thought about them the way that you mentioned it. First, let me say that here in Maryland, back in the GFC, we were probably one of the states that was hit the hardest and the slowest to come back. And people don't really realize it. They're so short-sighted. They only think about what's happened since 2020. And you're exactly right. I have a client that I sold their house last year. They paid $1.3 million for it in the peak of the market in 2006. And they couldn't get out of the house in the plus until 2022. And I mean, it took that long for the prices to come back. And yeah. But what I want to say here is you maybe think about something that, one of the, look, I've been saying since 2022, and I know timing's off. You've been saying the same thing, but we agree that this housing bubble is not sustainable. And I've been saying it since 2022 that we're having a crash is about to happen. But none of us could predict the government stimulus in the way that they've propped it up and kicked the can down the road. And I want to dive into that a little bit. But you said something very interesting, that now we're in the second largest asset bubble ever with housing. But you mentioned back in the 20s, even the roaring 20s, we didn't have the real estate bubble that we had because of, interest only mortgages, 5 and 6 year mortgages. And yeah, they needed 50% down to get those. And, but what you said, people want to say this will never happen again because loans are tighter than they've ever been or whatever. And that's not true. Yeah, but what you just said is the truth. Back in the 20s, look, it's still easier today, historically easier today to buy a home than it was ever before.
Well, yeah, that's been a big change since then. And people don't appreciate that. It was hard to get a mortgage back then. You almost had to be in the upper crust just to buy a decent home back then. And that's not the case now. And now real estate, again, because of government pushing real interest rates lower. And these zero rates, which even now Powell said recently, we may never see these zero rates again. I think they're going to be low long term, but you're right, zero rates because they push them so low. This is the number one thing to create a housing bubble, and the reason why we had what I call a second artificial housing bubble to follow the natural one into 2006. That was the greatest boom in history, which I alone started forecasting in the early mid 80s. I said, people, this is not a recovery from the long 70s recession. This is the greatest boom in history with the largest generation ever. And we're going to see a boom into 2007 that's going to last longer and go higher in stocks and real estate than anybody think. And people thought I was crazier back then than they think I am now when I'm bearish. Okay. And people call me now a perma bear. This is one of the few times I've been bearish in my whole forecasting life. But that's what people do. But yes, it's just there's never been a time where it was so easy to finance real estate. And again, for Chinese and the Chinese on such low income there compared to here. Imagine buying 2 or 3 small homes and you make 15,000 US dollars a year. That's what the typical Chinese person is. And a lot of those people have a second or third home and 1 or 2 of those are out of 2 or 3 are sitting empty, not even renting out. So it's just, this is a once in history sort of event. Stocks, since they were created in the late 1700s, have always bubbled and burst, and the rich have always driven them much more than anything else. But almost everybody, 60, 70% of households buy real estate. 60, 70% of people don't have anything significant in stocks and other financial assets, but they buy real estate. And so when the Fed, what they did, particularly as you said, it was COVID that really blew the top off, because COVID hit, and there's been, and I calculated, I'm the only guy talking about it, since the 2008-9 downturn, when they really started stimulating, $27 trillion in stimulus, 19 of it government deficits that go straight in the economy, and the other 9 million of it, 8 million of it went straight into the financial markets. They buy bonds and push all finance. That's more money chasing all financial assets, and it always ends up in the best ones, real estate and stocks. It doesn't sit in government bonds, which people buy. So there's this overreaction to COVID. I was saying, what's wrong with governments? COVID is a natural disaster. It's just like the influenza that happened 1918 to 20. It hit for 2 years. Everybody got it. Then it went away. Out of the 27 trillion I've talked about in stimulus in the last 15 years, 11 of it came in the 2 years after COVID. So it was this overreaction to COVID. It took inflation that, right with my indicators long term, going down towards 1 to 2%, never to be high again, and shot it up to 9%. And then that forced the Fed to raise interest rates 525 basis points. And right now, I'm looking at this and saying, we haven't really felt that much yet. Usually that's a year and a half lag. My theory is, since we had such a giant magnitude of stimulus, especially after COVID, and such a giant tightening, that it may be taking more like 2 years for these to filter in. And so we're not going to know how much this tightening, which is already done, they already went to 520, even if they started loosening in September, which is the earliest anybody thinks, and that'll probably just be 50 basis points, not much out of the 525. This tightening keeps hitting for a year and a half to 2 years after this. So this is going to go down as this is going to show why the Federal Reserve and central banks around the world, including Mario Draghi and all the ECB people over in Europe, shouldn't be manipulating the economy. What's free market capitalism? The markets are a bottom-up system that work way better than top-down bureaucracies and dictatorships and everything else that's been tried in history. That was the greatest innovation in history. Democracy, broad participation of people, and free markets, which really rewards innovation. People think, oh, democracy and capitalism are brothers and sisters. No, they're opposites. One rewards innovation strongly. The other one includes everybody, even if you don't contribute much. And that allows people to, identify with the system and support it. It's the best marriage, like male and female in history. So what we're doing now, since 2008, democracy's been weakening for a long time, a lot of ways, special interest and all this stuff and lobbying. But free market capitalism got attacked 100% by central banks starting in early 2009. And I call that the greatest crime in history. This is what has made us rich. And now academic people, do you know anybody in any central bank, any head of any central bank in the world that's ever had sex or run a business or looks like they ever had sex or actually run a business? And the answer is probably no. These people are dictating economies, playing with the money supply, and it's dangerous because of these giant lags. And everybody's saying, "Oh, the tightening didn't matter that much." Well, wait another 6 or 12 months. We won't know until early to mid 2025 how much it hits, and I think by then, even with a little easing, it's going to be worse than people think. Why? The greatest debt bubble in history. I cannot compare this bubble period to the roaring 20s or the 1820s and 30s, which is the other great bubble period of the 1800s, or the one from 18 Civil War into the 1870s, which came to the long depression over 20 years. Okay. I can't even compare it to those because this bubble has been longer and bigger. And again, the first bubble was natural. Just 25 to 29 bubble and stock. It was natural. The economy was so good. Inflation was falling for natural reasons, and people just get giddy and things end up in a bubble. Okay. No, this is the second bubble and two bubbles, which started in 95 and are peaking here, it looks like in 2024. This is the longest, greatest, and only double bubble period in all of modern history. And all I can tell you, since there's no precedent for a bubble this big and this global, it's not going to end well. No, and everybody says a soft landing. There hasn't been one bubble short. Even the tulip bubble, it was 2 years up and 1 year down, but the landing was down 98, 99%. That was the first modern bubble, and the steepest and fastest, only driven by the rich. Only richest people were speculating in these tulip bulbs and stupid stuff, driving up a $2 tulip bulb to $1,000. That's kind of what happened in reality. That bubble burst 98% in 1 year. So this can only end badly, and this is not a U.S. bubble. It's a bubble in everything. And the Japanese, it hit them first, and their stocks peaked in late 89 and only went to new highs 35 years later recently, and that's about to crash bigger than they've ever seen. And their housing peaked in 91 and have never seen and will never see new highs again. So real estate goes down longer and comes back slower because the real estate is demographic and it's local. Stocks are global. I don't care how bad we get hit in this crash, even if the U.S. is slower to come back, particularly because of the real estate markets and stuff. Stocks are global and they'll come back with the world, and the world will come back, especially emerging markets and some of the places that have stronger demographics than us. And of course, Japan has continued to lose no matter what happens because Japan was the first developed country to peak in their demographic trends long term, and everybody else is following. China is now the first and already has peaked in their demographic trends. Emerging country, and all emerging countries will follow, but it'll take decades for many. I mean, India won't peak until 2055 demographically. In Southeast Asia, 2045. So there's tons of growth in the emerging world and all of that. But for all the developed countries, U.S. is plateauing between 2007 and 37. And again, I am saying that when real estate crashes this time more than last time, only back to 2012 lows, which doesn't sound that much, but it is 60% now for the average house, 70, 80% for the typical upscale house. We will never see real estate prices at those highs in any of our lifetimes, and probably not even our kids.
Wow.
It's stocks in some places will. I don't think our stock market will ever see these highs either. I don't think the Dow will ever see 40,000 in any of our lifetimes again. But real estate definitely.
Yeah, let's dive into some of the reasons. But first, I want to talk about, and you mentioned Japan. Doesn't Japan have like 100-year mortgage or something crazy?
Yeah, they go out to 40 to 60, and I think they do have some 100-year mortgage. And that's what people do to stretch it and all. But again, Japan, people would say, well, when house prices go down, well, but no, Japan will never, ever be the same because unlike the United, we have the option, we have high immigration And we'd have the option, since we're the most attractive country still in the world, to up it if we really wanted to ask for it, okay? Japan has aging demographics and no immigration. They've never allowed much immigration, and their culture doesn't want immigration. I don't blame them for that. They have a great culture, but they are a dying. Japan is the example to the rest of the developed world of how the entire developed world is plateauing or dying. In only a few countries like Australia, New Zealand, and Norway, Sweden, and Finland. 5 small developed countries in the world have demographics that go higher in the future. All the rest of them are flat to down forever, as far as you can see.
Yeah.
This is a first in the world. Economists don't understand this because they think it's all politics. All they study is politics and politicians and what they're doing and this bill and that. I don't study. You know how much time I spend studying politics? None. I don't care who gets elected president. They don't drive this ship. They don't make that many decisions, and they take too long to impact, even if they do. Doesn't matter to me if Joe Biden's reelected or Trump gets in, okay? Maybe for certain bills or certain things, but for the overall economy, I don't base any on that, okay? The baby boom generation caused the greatest boom in history. When it failed, governments overstimulated everywhere. And now the millennial boom that when the U.S. will peak around 2037 has already been pre-boomed. It's already been mostly played out with all the stimulus. People have bought homes bigger than they could afford, or they bought homes earlier than they could otherwise, all the stimulus. And then once we wash this out, I think, we're going to be very slow to come back, even though the millennials are finally driving us up again after the baby boomers. Why? We didn't allow the economy to do what it does best. It knows how to boom and scale up. It also knows how to detox, restructure debts. I always tell people one of our biggest innovations, underrated, is bankruptcy. There was a time when we didn't have bankruptcy in the world. You went bankrupt, they just, pillaged and took all your assets. You went bankrupt, your credit was destroyed forever and game over. Somebody came and said, "Oh, hey, why don't we bankruptcy, have a little period, renegotiate, and then do a win-win for the creditor so the company can keep going. Otherwise, the creditors lose everything if the company goes under. So we have Chapter 11 reorganization instead of just Chapter 7 bankruptcy." That was a huge invention in history. That's what the economy is going to go through. This is going to make the economy stronger. That we've never had a debt bubble this pervasive, this global. But again, it's been a bubble in everything, all financial assets, stocks, real estate, commodities, everything. All these bubbles will burst. The cost of living will come down, which will help the everyday person more than anybody. And what I tell people, and I'm usually lecturing to richer audiences by far, I'm saying you guys are the ones in trouble here. You're the ones. The top 20% own 86% of the financial assets that are going to go down here. The major theme of this is not the downturn and how high the unemployment, how long it lasts. It's how much financial assets go down. That's the rare event. That's what hit the richest people the hardest. Whereas unemployment, I would way rather be the everyday guy and lose my job for a year or two while getting benefits from the government than a wealthy person that loses 80% of their net worth, and it never comes back that level, or very slow to come back. I'd rather be that guy that lost his job for 1 or 2 years and get some welfare.
I hope you're enjoying Harry's interview so far. Now, I'd just like to mention that this episode is brought to you by our own SachsRealty.com. If you're interested in buying, selling, or renting, and you're in Maryland, we hope that we're your number one choice. At least give us a call and a chance for your business. And if you're anywhere else in the country, you can visit SachsRealty.com. We have an amazing broker network all over the country. Simply click on your state, the city drop down to find an agent in your town. This is a new program for us, and if there isn't an agent already in your town, please send me an email, and I will be sure to connect you with somebody that I trust. Now back to the show. What you just said, I mean, I've never heard anybody say it, and it makes the absolute most sense. So even the people that are running this country, I mean, they're rich, they're wealthy. And so what's happening is we're about to do a massive transfer here of assets. And we have built, what you're saying is because of the prosperity of America over the last 30 years, really. I mean, even though the GFC, even though the dip, whatever, but you take the last, just call it 30, 40 years of prosperity where, the average American, the baby boomer, has been able to amass this asset, which really, comparing it to the Chinese, they're doing it on a much smaller scale. They only make a little bit of money, but they believe in this real estate asset. But now when we look at it, the millennials, they can't afford this asset debt, even the debt that comes along with it. So we look at more McMansions now than we've ever seen historically in the United States. I mean, when post-World War II, when soldiers were coming back, the government cut red tape to build affordable housing. These were 3-bedroom, 1-bath houses. Everything looked the same.
And at that time, the Bob Hope generation was young coming out of war. They were the young soldiers who now needed to become the new homeowners. And so that was a very timely time to do that sort of thing. And that's the problem. The lucky millennials here are the ones that did get priced out and didn't end up buying a house, couldn't they afford to? Because when this happens, they're going to turn around and say, oh my God, forget that 2,000 square foot house we were looking at, honey.
Or bigger.
3.5 to 4,000 one that has gone down 70%. And the government's telling, yeah, okay, banks are a little skittish about lending. The governments are going to be pushing banks and rewarding them for lending. They're going to want to see this recovery. And the only way is to stimulate home buying by these millennials that never got to buy a home. That is just like after World War II. That's going to be the way to pull us out of this. So the government.
Yeah. And then you have all this.
To lend.
And then you have all this inventory that is 36, 4,000 square feet, 5,000 square foot houses. They can't afford to heat and cool it, let alone, even if their parents gave it to them, they're going to be in trouble because the taxes alone, the property taxes, the insurance, the HOA fees, and everything else, they're going to need a bulldozer to those houses. So but what you're saying makes it is probably,
well, if the prices come down, so will the property taxes and other things.
They'll have to. Yeah. And but to your point, this reset is really coming. And I don't know that the way you just described it, I don't know that it's even possible to stop it. The only way that you could stop it would be hyperinflation. And that would be the government printing more money, injecting, doing more quantitative easing. And that's just going to push asset prices even higher. So, I mean, it's brilliant the way you just described that. And I mean, if people can't, if people are so quick because we are so short-sighted and looking back, and I get it too in the comments. They're saying, you're wrong with your projections. You're wrong with, I'm going, how can I be wrong? I don't want to be right. But when I'm looking at, okay, the only way that this can correct in the same trajectory would be that if employers tomorrow all of a sudden said, I'm going to take the biggest line item on my income statement, salaries, and I'm going to make it even more. I'm going to pay everybody double and triple what they're making right now so that they can afford to live. And Harry, I think that you would agree that's not going to happen.
Well, again, everywhere I go, and Australia is my favorite place to speak, but they're also the most delusional. People there think high housing prices are a good thing. High housing prices, real estate prices, increase the cost of consumers living and business costs and government and everything. Who owns more offices than governments? Okay. So this housing thing coming down is going to improve our long-term standard of living. The trick here is if you haven't bought one, thank God, and don't be tempted to yet. If you can sell one or two of your houses, sell and create as much cash flow as you can. If you can sell anything, home price. I bought a house when I moved to Puerto Rico because I got a deal that was just could not resist. I already bought something that was 30, 40% lower than it should have been because it sat empty for 5 years after a death in the family, and they just threw it back on and didn't even know what it was worth. I just saw it and bought it right when I was telling people in my newsletter, not a good time to buy houses. Well, I've already covered if we get in Puerto Rico is going to hold up way better. All Americans moving here at upscale homes, but even if it goes down 30, 40%, I won't even be close to what I paid for it, and we're adding value to it. So I was able to not have to wait. My wife has not had to have me wait to buy a house when we moved to Puerto Rico because we got lucky. But man, I'm telling you right now,
I want to look at a couple charts because I think this is going to support what you're saying, even though it wasn't meant to. And I think that we're smart enough, if people would just look at the data and the information instead of just turning their nose to it and saying, that's not true or whatever. And then all of a sudden waking up one day and saying, wow, I mean, let's just say we, hope for the best and plan for the worst. Like you said, if you haven't bought a house yet and you were depressed about it, you may find out that the tide has shifted and now you can get what you want and you'll say, wow, I'm glad I didn't. But there is going to be a painful road to get there, because one of the reasons why people think of the GFC, I was in it. I mean, I work in real estate. And, people thought, well, the subprime mortgages were the only thing that was the catalyst for the foreclosures or people turning in their keys. And it's not true. What was happening was, and I know this firsthand because I dealt with the people and I watched it happen. People were saying, oh, I could buy the house across the street, which is nicer than mine, for $150,000 less than my mortgage payment. I'm going to stop paying my mortgage. And they just basically turned in the keys. And this was, so it wasn't just the fact. So when we look at, okay, real estate prices, and they have come down, by the way, at least in our area and the markets that we trend, the brokers that I speak with, some areas are already taking 20%, 25% haircuts. We're seeing inventory explode. We're seeing days on the market explode. We're now seeing more seller contributions than we ever have in the last 4 years because, they didn't have to fix things 2 years ago. Now sellers are, and sometimes it's a costly repair. So that is that is an improvement, on affordability. But what I want to look at these articles, because Housing Wire, and I subscribe to this, and, I have the premium version so I can get a whole bunch of, data that they just don't push out in the news. But in this, there's an article that was, this article here that was dated July 10th by Mike Simonson. He's the CEO and the founder of a real estate analytics firm, Altos Research. And by the way, a lot of these firms are they're cropping up everywhere. Lance Lambert, I just interviewed Lance. He has his own now data analytics. He was with Realtor.com and then was with Fortune magazine. But this article states that, and this is, Harry, this is the critical part that they look at these headlines and then they doubt the ability that all of a sudden one day they wake up and find out, they weren't reading the data correctly. But it says now only 76% of American mortgage holders have an interest rate below 5%. Now, you may say, well, that's a lot of people, but look at the details here. That is down from 85% level from just 2 years ago. So it appears the low interest rates of mortgages are starting to churn to higher mortgage rates. As we've seen, now mortgage rates have been over 5% for more than 2 years, but still historically low, but not once you consider the asset bubble. But in this chart here, it talks about, there we go. It shows, which is really interesting. In this chart, it says that if we average, and this is, Mike Simonson here writing this, but it says if we average the loan to value ratio across loans in the country, we see a dramatic improvement over the last decade. In 2013, nationally, we had a 70% loan to value ratio on outstanding mortgages. Now, after a decade of dramatic home price appreciation and an expanding economy, mortgage holders in America have only 48.3%. But what people aren't realizing is that's the bubble, right? I mean,
the bubble value.
Quick that can be wiped away. So when people are looking at this chart, they kind of feel like they're safe. Meanwhile, their property taxes have gone up, their HOA fees have gone up, their repair costs have gone up hundreds of percent in a lot of cases over the last decade. I mean, what was $2,500 to put in a HVAC unit is $25,000. Now to have with everyone's expenses gone up. But let's look at this next chart. It says improvements in loan to value from 2014 to 2024 with higher numbers imply stronger borrowers throughout the country. And this map, beautiful as it is, shows everybody like, hey, if you live in Florida, you are a 27% stronger mortgage holder. Now, here's what people don't realize. Houses are not a fungible thing. I mean, you can't take there is no exact analysis to say, we look at this data and it's like, okay, this data is great, but it's not accurate, because what people don't realize is when they let their home maintenance go and, things start falling apart and things start breaking. And what they really don't realize is a house is not a liquid asset. You have to have somebody buy it in order for these values to be good. So when inventory starts flooding the market and these buyers are saying, yeah, I think I'll wait a couple more weeks or months and see where it's going because it's a downward trend, these sellers and mortgage holders are in for a rude awakening.
Yeah, that's another thing. If stocks are going down, I can sell them in a second, even as they're going down. Real estate clams up, like you said. When things start looking questionable, real estate just gets hard to sell. Period. That's why I'm telling people, man, if you've got real estate that's not dear to you, and you're not going to be in 5 or 10 years from now, or whatever, or already retired or something, then move it now, because it can get difficult very quickly. Again, I can be down and say, oh, I wish I'd have sold stocks last month. And it can be down another 10%, but I can still sell that stock in a few seconds.
What do you think? Kind of walk us through the scenario, because I think that you're spot on with the fact that this can't continue, and I think that we are in some pretty dangerous territories with the respect to affordability, and the housing cost is just it's when we look back. I had a podcast with a guy, and he's a nice guy, but I look, I'm not trying to say that I know it all, and I don't want to know it all, but I've been in business for 35 years. I've been in the housing market, serving the housing market for 35 years. That's a long time. I've seen a lot of things from the 80s to the 90s and I interviewed a young guy, and no knocking on young people out there. They're the future and hope of America. But it was funny because he said, we got into this debate. I said, we're in a really awful affordability crisis where homes really haven't been this unaffordable for the American family. And he said, actually, that's not true. He said in 1978 was the worst. It was way worse than now. And I'm like, well, how do you see that? And what we've been sold in America is that finance is there as our gauge, not actual asset price. So it's like, what can the payment, what's the payment? What's the
mortgage interest was high in the late 70s.
Yeah, was it higher? But you could still 3 to 4 times your annual income. You could still afford to buy a house. And the crazy thing about it is, I think it was, and I could be off a little bit on these numbers, but I think 48% of married couples had the mom working or at home raising the kids, not out making an actual income, paying for the bills. So back in that 70s period, yes, you may have had higher interest rates. People put more money down. The asset was 3 to 4 times their income. Now we have markets that are 9 and 10 times median income for median priced home. So, you could take all this data and all this, garbage, but Harry, what do you think? I mean, you've been around, you said it. I mean, you deal with a lot of people with a lot of wealth. You're advising them. You're an economist. You're an author. You've forecasted. You have a very long track record, and it is hard to pinpoint. Critics want to say, oh, you're Mr. Doom or whatever.
The government is acting. I called the 2007 top in stocks, that whole boom, decade before it happened. But the government hadn't started intervening. They started taking over the economy in early 2009. That's when things changed. And now everything's perverted. And they cause. That's why this second bubble in stocks, and more so in real estate, 100% artificial. It's not based on favorable demographics or productivity or anything else. And some of those things have been good enough. It's just totally artificial. So it just means this bubble is more dangerous and is going to have to fall farther to get back into reality. And when that happens, you get this overnight, baby boomers lose and millennials win, especially the ones that didn't buy a home. But even if you're sitting in a starter home and your next is going to be a double the size trade-up home, you win if that trade-up home comes down to the cost of your darn a starter home used to be. So the millennials are the winners in this. And the ones that have bought will feel some pain, but the baby boomers are the ones that got to sit back and say, whoa, because I'm telling you, I can talk people out of stocks easy. I've been giving speeches for 30 some years now. The hardest thing to talk people out of is real estate because they're attached to it. They fall in love with it. And they've been told since they were a kid and by their grandparents and their parents, real estate's the one thing that never goes down. In 2006 to 12 already disproved that. And this one's going to disprove it forever. I study the history. There's been plenty of real estate busts if you go back in history.
Yes, yes. And I mean, every decade or so, since probably the Great Depression, but even prior to that, I mean, we had natural corrections where the economy would get out of place, back into the 1800s. We had panics.
Through the 1800s.
Yeah. Yeah, we had panics, booms, busts. We had pandemics. We had all kinds of things, recessions, depressions. And, but the difference was back then it happened every year, 2 years, and it would automatically adjust itself. It was correct because we didn't have the government, kicking the can down the road. But what do you think? I mean, you've had to have thought about this. So if you had to talk about the progression, and I know you said that, first things show up in the stock market, where you see real earnings. I mean, earnings reports are going to start. I mean, there's a lag effect, but eventually these second quarter earnings reports are going to come out. They're not going to look good. Stockholders are going to start to lose interest. This is kind of a decline that can happen like super fast. But what do you think if you had to step us through not necessarily a timeline because we know that can be padded, but what would be the progression? Will it be higher unemployment? Will it first start with earnings reports? I mean, what do you think will get to the point to where we'll start to see a pretty rapid deterioration?
Well, it's really simple. The stock market is a leading indicator. The stock market's always looking forward. And so if something's going wrong, they're going to smell it first, okay? And so I really track most the NASDAQ since it's a little more progressive than the S&P 500, a little more tech-oriented stuff. So basically, I'm, the 2022, NASDAQ went down 38% in 1 year. That was the first warning. Hey, folks, something's wrong. Be one thing, stocks correct 10, 20% all the time. 38% in 1 year? No. Well, that was COVID, okay? But the only reason that didn't last long is because governments overreacted to COVID. But it's the overreaction to COVID which is the problem now, and it has created a bubble way bigger than it needed to be. And so I'm my major thing. If I'm somebody and I'm looking at real estate, I would basically the best leading indicator. If the NASDAQ starts crashing again, and I think you're going to see that soon, that's the first sign that something wrong. That's when I start saying, okay, I got to get serious about selling any real estate that's marginal for me and I don't want to keep forever. And get on it. And don't be waiting for the best offer when you get in that zone. So I think stocks are the best leading indicators. Stocks tend to lead the economy by 6 to 9 months. And then the economy going down is what obviously most hits real estate. People are going to really, real estate's the biggest decision you make, the biggest thing. You're making a down payment that is leveraged 10, 20 times on the overall impact on the economy and your debt and everything. It's the biggest thing we do. So housing is what clamps up the most when the economy reflects it more than it's not going to react to the stock market. But I'd use the stock market as saying, hey, the NASDAQ starts crashing again. You better look at your real estate.
So let me just ask a question there before you can continue, because then I want to talk about the economy and the indicators and what your projections are for that. But do you think that we'll see? All right, we've seen, and I want to, I can't let you get away without talking about the latest Janet Yellen interview with Yahoo Finance. So I want to definitely get to that. But when we look at the stock market as it dips and goes down, it reminds me of leading up to 2008 housing crisis. So when the stock market started to go down, I watched investors yanking their money out of the stock market and they were putting it in real estate, which even jacked it up that much more and really created. And I think that was really where the subprime that served that market, because those people shouldn't even have been buying real estate in the second and third and rentals and rehabs and
back then.
Yeah. So, do you think that when we see the stock market or earnings reports or whatever, the forecasts come out and they're not as, or the investors, the smart money, the more educated investor says, "Hey, look, I'm selling now. I'm getting out of this stock." What will they do with it? Do you think we'll see a almost like a dead cat bounce to real estate? I mean, or do you think that they'll be too savvy at that point and too cautious to invest in real estate?
No, I think what people have done and totally incentivized by central banks around the world. Okay. They cured the 2008-9 crisis by creating a bigger bubble. Okay. And that bigger bubble hits real estate for most people more than it does stock because way more ownership. So all it takes is for real estate to stop going up and start to show any weakness. And people already have overbought and overcommitted. Why? Because it seems like you can't lose. As soon as there's any sign, oh, this is stalling, and then it's going to start going down in certain places, and it's going to start in the high end before the everyday, and in certain areas, the bubbly areas like Florida and California first. But once it starts, people's antennas go up, and the truth is they're already never before have people extended themselves and borrowed this much against real estate, thinking you can't lose. And this time, at least you have a recent reference point because people didn't have it before. A reference that, oh, yeah, in 2008, real estate went down 40 to 60%. Okay, so people now know it can happen. Before then, people would tell me, Harry, this just can't happen because
Mhm.
because there's endless demand and there's not enough supply. Okay. Once that crash happens, that's changed things. So
That makes
people
sense.
saw that crash. A lot of people went to that. So people are going to be quicker to react this time, from my point of view. They got educated by the last one.
Yeah,
And
makes
there's
sense.
no way, from my point of view,
Yep.
I don't care about all the metrics, affordability, da, 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 da. All I know is this real estate bubble went higher and lasted longer than the first one. So there's no way it's not going to be a bigger crash. And again, I'm a chart guy. I like to look like at a chart as if I don't know what it is first. And if I just looked at the real estate chart, it'd be a slam dunk. We had a three-wave peak in 2006, a four-wave bottom in 2012. Now in 2024, we're in a fifth-wave peak, greatest single time a real estate bubble ever. And there's only one place this would crash to, the 2012 lows. Now, it might go lower than that, but that is the most obvious target.
Hmm.
And what I'm trying to tell people, if somebody said, oh, it's going back to 2012 lows, oh, no big deal. No, that's 60-some% for the average house. It's a
It's a
huge
big
deal.
deal.
That's
Yeah.
how people don't realize how big the bubble's been since, not the one in the 2006. That was the first bubble. This bubble is bigger and longer. And because the government pushed it so hard and pushed interest rates slow and made it so easy. So people have to realize the enormity of this bubble. There is not a comparable bubble in real estate. I can compare this stock bubble to the 29 bubble and the crash commensurate, okay? And it will be about that. I'm predicting 86%, 7% down for the S&P, 92% down for the Nasdaq. That's right in line with 89% for the Dow in 29 to 32. Real estate, there is no, oh, let's find one like this. This is going to be worse than the crash before, and it's going to be way worse than the real estate crash in the Great Depression. Because again, there was no real estate went up more normally back then because
Right.
it wasn't possible. There
Yeah.
was not the ability to get in a financing bubble.
Makes 100% sense. Yeah. Yeah, I mean, you're looking just like you said. I mean, for people listening, if you didn't understand what Harry said, clear as day. I mean, people invested back then when they took their money out of the stock market. They helped fuel the asset bubble of housing before the 2008 crash because they looked back historically and said, this is the safest bet there is. And, and
Yeah,
now,
that's right. The tech bubble burst in 2000, and people say, well, gosh, real estate hasn't bubbled yet, and real estate never goes down. So people went, you're right, they went, and this is during a recession. It went right into real estate and stock. The
right,
fall in stocks caused people to go directly into speculating in real estate instead of stock.
right,
And then that's why you got the 2006 bubble. And again, the bubble didn't burst because the economy got weak. The economy was strong until the end of 2007. Real estate peaked and started going down early 2006, but
right.
precisely because it priced itself out of its own market. And,
You're
and now it's
spot
way
on.
worse. We don't need a recession for real estate to start going down, but any
Interesting.
sign of recession, and then it just
Hmm.
accelerates.
And that brings me into the next part that I promised myself I wouldn't let you get away with without talking about it, because you had mentioned it didn't matter who the president was. And, and Harry, in 35 years of self-employment, I've always said that same exact thing. It was like, you know what, the president, I'm okay. I think I'm not going to go political on it, but there's so many other people that are running things that, that are pulling the levers, right? And I think of
change. Things take a while to get through the whole legislative system and then get implemented. Yeah.
Right. So, but Janet Yellen, on the other hand, the Secretary of the Treasury Secretary, she last month was actually sitting down live in this, and I forget who the interviewer was, but I watched it, and it was on Yahoo Finance. We'll drop the link below for anybody to see it. But Yellen spoke on housing affordability, which to me, I thought I was listening to President Biden because I didn't understand what she was talking about. But she said, she went over these programs that they're working on, and I tried even looking them up and trying to decipher like what the heck these things were. And I'm like, I don't even have time to do it, but it didn't make sense. It wasn't like a clear to me in the housing market. It wasn't like, oh my gosh, this is a great thing coming. I think that when the government says that they're here to help, I see, a lot more regulation, a lot more cost. It's like a misnomer. There is no affordable housing in affordable housing, in subsidized housing anyway. And everybody fights that in their community anyway. They're like, yeah, we need affordable housing, but no, I'm going to stand up and fight it when it comes to my neighborhood because I don't want it, right? But anyway, she spoke on housing affordability. And the biggest thing that she was talking about was she said that a recession wasn't in the outlook and that the U.S. economy was strong. And I'm wondering, like, what? And this is recent interview. This isn't like, this is after, however many job revision reports about how it wasn't as strong, 439,000 jobs that were misquoted last year. These are documented, not my saying it. It's a fact. But yet we look at it and we go, okay, I know I can go off of what I know. I'm not a rocket scientist. I'm not an economist. I'm a real estate broker, right? That has survived in business for 35 years. Thank the Lord. But I look at it and I go, okay, home prices are ridiculously high. Rents, ridiculously high. Cost of living, ridiculously high. The interviewer even said, Ms. Yellen, have you gone to the grocery store? Let me ask, do you buy your own groceries?
This cost of living is the biggest factor in cost of living. Right. And it's gone up the most. It's the most inflated of all.
Do you believe we can have a soft landing?
No, it's impossible after a bubble. Bubbles end up, here's the difference between a long recession like the 70s, okay, and a depression like the 1930s. The depression followed a bubble. Bubbles end up in depressions because bubble bring financial assets to more extremes and they have to fall, and it destroys wealth. And that's longer to come back. You can lose a job and then it comes back and you're back at a similar wage and you come back normal. You lose financial assets, go down 60, 70, 80% only in a financial asset bubble burst, which only happened 29 to 32 and then 2000 to 2002. And now again, 2024, I'd say to 27 or something like that. Those are rare. And those have a bigger impact and take a much longer time to come out of. You can't just skate over that. Okay. And the truth is, we had the greatest economy for decades after the Great Depression and World War II. Those are the worst two things that happened in all of U.S. history back to back. And it was followed by the wonderful 1950s where everybody was happy. Happy days, they call it. Happier than the 90s. That was the greatest decade for boom in history. I call that in advance, because the demographics were the strongest there. But the 50s was the best time in history because you came out of adversity makes you strong. What doesn't kill you makes you stronger. So people looking at my forecast for stocks down 80, 90% and real estate down 50 to 60. Oh, Harry, that's the disaster. No, this will bring our economy back into balance after going extreme imbalance and make us much stronger. And we need to be stronger because we, like most developed countries, are aging. Our average age is going into the 40s when it used to be in the 20s. Okay.
Mm.
And like you say, just 20, 25 years ago, an average solid house in Ohio was 100,000. Now it's 420. It's 4.2 times 25 years later when the cost of living's only gone up maybe 50, 60%. That's not good. That's the worst thing young households are facing. And like you said, I'm a baby boomer. You know what I'm going to be in 20 years? Dead. I'm not going to matter. The millennials and the people before, younger than them are going to be the future. And this reset in housing, as painful it'll be for everybody, including some of them, is going to be the best thing that ever happened to them, freeing up them to be able to afford a better house and have more money left over to buy everything else, eating out, food, cars, everything. This is going to be the best thing that ever happened. And again, it goes back to, where did economists get to the point of view of recessions are the enemy? Recessions are as essential as booms from my research. And I learned that in my first jobs. I came out of Harvard Business School, turning around Fortune 100 companies in trouble, to doing the same thing with new ventures in California. I could make 6 times the change. When you're in a crisis, you can make changes faster, and that's for the better long term. I realize a crisis is an opportunity. It's not a bad thing. Recessions are necessary. Recessions necessarily are 30% of the time, if you look historically, versus boom, 70. And guess what? It's the same exact ratio of being awake and functioning and being asleep and dreaming. Try not sleeping for 3 or 4 nights. You'll be a crazy person. So economists think recessions are the enemy and we have to prevent them. Recessions are necessary. And if you don't want to have a bad recession, don't have a bubbly, debt-ridden boom. That's the answer. Don't prevent a recession. It's like stopping your body from taking a crap. It's not healthy. It's elimination. Recessions are a natural elimination after a growth period. They go hand in hand. And yes, if you have a healthy economy, recessions are only so much, and they're only 30% of the time. It's a great trade-off. Don't mess with Mother Nature. Don't mess with free market capitalism. That's what I started this interview with. This is the biggest attack on free market capitalism since it was created by Adam Smith in the 1770s, okay? Along with democracy, 1776, okay? The Declaration of Independence in the U.S. Those two things are the big bang of all history, and now we're attacking both of them, but we're really attacking free market capitalism. George Gilder, he's old now, but he was my favorite economist because he says, it's not just about the freedom to innovate. The economy has to allow and foster elimination recessions. You have to accumulate and eliminate to be healthy. You have to eat and crap, for crying out loud. And that's what economists miss. They think we just should grow 5% and never have that would be a good economy. We grow 4 to 5% a year above average and never have a recession. That economy would be dead in 2 or 3 decades. Recessions keep us healthy.
I think one of the things that I love so much about talking with you is your hope, because, identifying, and just like I had said earlier, and I studied the booms and busts going back to the 1800s, and recessions were quite frequent. And like you said, I mean, that was healthy. It adjusted naturally. Mother Nature did its course.
But they were smaller.
They were smaller. Yeah. Less consequential. And so let's kind of end on, because I like your hope, and I like the fact that you believe that at the end of this day, we're going to be resilient, and it's going to be a way better life for our youth, our millennials, our Zs, our alphas coming up, that want to have hope, here in the U.S. So let's first talk to, not so much the silent generation, but let's talk to baby boomers. If you had to think of one thing, advice for the average, not the wealthy, not the impoverished, but if you had to talk to the majority of the class and you had to give them one, statement or words of wisdom, what would you say to those baby boomers right now?
Yeah, it's simple. hunker down. We have lived through and created, we were the creators of the greatest boom in all of history. Don't look a gift horse in the mouth. We have to consolidate that and do the recession thing here. We have to shake out all these debts. We have also the highest debts and the highest number of zombie companies in history. That's the negative thing. Welcome this shakedown, and you're going to be the big winner if you do everything right now to sell all the financial assets you can, especially real estate and certainly stocks. Stocks you sell. Get out of stocks. Don't hold out for the next 5 or 10% you might miss. Worry about the 50 to 80% that comes so fast. You never get out in time, and you lose most of your net worth for a long, long period of time. So you sell financial assets, examine everything you own. Real estate, you have to move the hardest on because it's take the longest. Stocks, you can sell in a moment. Sell your stocks and work on selling your real estate you don't need. And if you want to keep one of your two houses, okay, again, pick the one with the most debt against it, which you may be able to negotiate out of some of that debt. And then sell the one with the most equity. So just this is a time to hunker down and just say, look, we've had the greatest times. You don't get great booms without growth, but don't listen to anybody that says soft landing after the greatest boom in history. It's impossible to have a great boom and then a tiny bust. Never, ever happens and shouldn't happen. This is going to be big when it happens. So all you got to do is get out of the way. And hey, if you got a good job, be extra nice to your boss and work a little harder, okay? Or if your kid's got a job, tell them to quit bitching about the boss and then be nice to your boss. Because even in a downturn with 25% unemployment, 75% of people still employed. So if you have a good job, you want to be one of those 75, 80% of people still employed. And that's not hard. Just work harder and be nicer to your boss than most other people in your office or your company. So it's easy to react to this. You just got to, the hard part is accepting reality. The great bubble, the easy times. I mean, everybody's gotten rich sitting on their ass on their sofa in their $100,000 everyday home that's now $420,000. Imagine it's the same home. Okay. That wasn't deserved. That was an undeserved gain. Thank God for that. And now sell everything you can, liquefy everything you can.
What do they do with their currency?
The U.S. dollar. Everybody said, I mean, all these people like Peter Schiff down there in Puerto Rico, they have the same thing, a bubble, bubble, bubble. They think we're going to end up in hyperinflation. They're just going to print infinite more money. Okay. They're already going in the opposite direction. The balance sheet's already going down, not up. Okay. So gold is not the safe haven. So again, the thing is to get out of financial assets, hold on to whatever work or job employment you have, hunker down so that you can have maximum ability to reinvest.
To just be liquid.
Everything. This I call it the crash of a lifetime, but the flip side of that is the sale of a lifetime. The last one was really of a lifetime was 82, and before that, 32, and to a lesser degree, 2009. I even say, I don't say 2009 because even back then it was hard to read because that downturn should have lasted longer. Somebody could say, well, why didn't you tell people to buy in early 2009? Well, truthfully, that crash should have lasted into 2010 if they hadn't come up with this massive stimulus, which had never been done. People don't realize they didn't do this in the Great Depression. They didn't print trillions and trillions of dollars. And again, 27 trillion. What I tell people, think about this economy, and it's been a little slower than in the past. Think what it would have been like without that 27 trillion in stimulus infused by the U.S. government alone and the U.S. economy alone. Think without that over the last 15 years. That's 10%, 6 to 10% of GDP. We would have had negative GDP, i.e., a depression. It would have been the 1930s. My demographics forecast that it would be like the 1930s. What we did was we paved over a depression as if there's no consequence of that. And I'm saying now, you want to see the consequence? It's right in front of you. It's the biggest bubble of everything in all of history, which has never occurred to this degree and in everything ever. So this is going to be very painful just to get back down to reality. This is not a punishment. We're just going back to reality after governments panicked over COVID and overstimulated in 2 years. 11 trillion of this 27. I said came in 2 years after COVID. If that's not going to go down as an overreaction, and people are going to see that created this second artificial bubble, and that created the greatest bust in all of history, only to be rivaled by 29 to 32. That's what
So,
this thing's going to end up. And it's going to be obvious. And when this happens, people are going to immediately go, oh my God, what was I thinking? I knew this is something for nothing. People know this, but when the bubble's happening, they're getting rewarded, and their friends are doing it, their neighbors are doing it, and blah, 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 and their relatives are doing it. And they just go along with it. And then they're getting rich. And what's there to gripe about? When this burst, I'm telling you, people will immediately, everybody's going to feel like I'm the stupidest person on earth. And the only consolation is no, 90% of the people went down with you.
Yeah, everybody be in the same boat.
Same bucket.
Yeah.
And they lost, 60, 80% and couldn't sell it if they gave it away.
Harry, what about the youth?
There's homes you can't give away. They have, China, 22% empty homes that you can't even give away.
Yeah. How about the youth? I know your advice just now about, be grateful you have employment, and be one of the, if unemployment were to go to 25%, work to be one of those 75% that still stay employed. And, part of that is helping your employer win by not complaining and showing up every day and doing the best that you can, and, being a good steward of your opportunity. But what do you say to them about debt? Because, so many of them, are running credit card debt. And for somebody in their 20s with a $5,000 credit card balance, that's as much. I mean, you may as well call that $1 million in debt, because to them, they're just getting soaked at 30% interest rate every single month, paying the minimum payments and still needing to go even higher. What do you say to these young people that are caught in all this?
Well, older people naturally save more. Young people naturally spend more. You do have to curb your spending here. This is not the time to certainly don't borrow at 22% on a damn credit card. If you've got a 4 or 5% mortgage loan on the first house you bought, and you like that home and blah, 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 okay, maybe you can stiff it out. You're going to lose a good bit of value in that home and stuff. But don't take on new debt, and certainly don't even think about borrowing, accumulating credit card or high interest debt. But if, let's say, you just inherited some money from your dying parents, and you say, well, I got this mortgage loan at 4%. Don't pay off that mortgage loan with that debt. Hold that money in cash. Cash is going to be king in this downturn, because everything's going to be on sale. So don't pay down low interest debt. Don't take on new debt, and don't take on any high interest, but don't pay down debt if you do get a windfall or like an inheritance from your parent. But don't buy a house with it either. Just wait a few years and you'll be rewarded. So patience is going to be rewarded the most in your lifetime, in probably in the next 2 to 4 years.
Everything will be on sale. Ladies and gentlemen, that is Harry Dent. I tell you what, this is great words of advice and wisdom. Guys, as I always say, if you hope for the best but plan for the worst, we're going to come out of this okay. So, Harry, before we get out of here, how can people follow you?
HarryDent.com. I got a free weekly newsletter. You get an article from me every week. You get a rant from me every 2 weeks. So this is a way to get to know us in this time. And boy, you need to be listening to more than the mainstream people right now, because nobody's going to the government and mainstream economists couldn't afford to tell you what I'm telling you, even if they thought it themselves. Okay, because it would look like they're doing something bad for the country. So you got to get the truth from somewhere, and you can get it for free. HarryDent.com.
Harry, thank you so much.
We'll do it again.
Yes, sir. I appreciate your time. All right, wow, thank you so much for making it this far. What did you think of our interview today? If you liked it, you can hit that thumbs up button that will let Harry and I know that you did. And guys, if you haven't already subscribed to our channel, what are you waiting for? Take the opportunity, do so now. Select that alert bell. You'll know every time we upload content just like this. One of the biggest compliments that you can give me at Sachs Realty is to share this content with your family and friends so that we can build an amazing community following the housing market, the U.S. economy, and geopolitical issues that we're faced with today. If you'd like to, drop a comment below. I'd love to hear from you. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.